Chapter 1, Introduction to Accounting. So here, over the centuries, accounting has remained confined to the financial record keeping functions of the accountant. But today's rapidly changing business environment have forced the accountant to reseize their roles and functions both within the organization and society. The role of an accountant have now shifted from that of a mere recorder of transaction to that of the member providing relevant information to the decision making team. So here, broadly speaking, accounting today is much more than just bookkeeping and the preparation of financial reports. So here, when coming to the accounting and the accountant, so accountant is a person who is going to maintain all the accounts of the organization. So when coming to the accounting today, so when coming to the accountant, he is not the person who is going to keep the books of accounts, but his roles and responsibilities has been changed. So now accountants are now capable of working in exciting new growth areas such as forensic accounting, which means solving crimes such as computer hacking and theft of large amount of money in the internet. Then we have, when coming to the e-commerce, so or financial planning, environmental accounting, etc. These realization came due to the fact that accounting is capable of providing the kind of information that managers and other interested persons need in order to make better decision. So when coming to the organization here, what are the accounts which were maintained by the accountant is not only meant for the accounting purpose. It is also meant for the decision making purpose, where it will be required by the different users. So when coming to the users, we may have internal users as well as the external users, and to solve the problems in the organization, accounting information will be playing a major role. Now let us see what is the meaning of accounting. So in the year 1941, the American Institute of Certified Public Accountants have defined accounting as a part of recording, classifying and summarizing in a significant manner and in the terms of money. So here, whatever business transaction we have in the business, those transactions will be recorded first. After recording, the transaction have to be classified into the different categories and it has to be summarized according to the calculations. So if we have any additions, it will be added, or if we have any subtractions, it will be subtracted to know the financial position of the business and to know that whether the business is going in profit or loss. So it is very clear that accounting is nothing but recording, classifying and summarizing the business transactions which are in terms of money. So why in terms of money? In accounts we are going to record the transaction which deals with the money. Apart from the transactions which were not dealing with the money, we are not going to record in accounts. After having an idea about the meaning of the accounting, we have to appreciate the exact nature of accounting. So here we must understand the following relevant aspects of the definition. So where we have economic events, identification, measurement, recording and communication, then we have organization, then we have interested users of information. To understand the nature of accounting, we should understand the definition of these particular points. Now let us take one by one, where first we have economic events. So when coming to the economic events, business organization involves in economic event. An economic event is known as a happening of consequences to a business organization which consists of transaction and which are measurable in monetary terms. For example, purchase of machinery, installing and keeping it ready for manufacturing in an event which compromises number of financial transactions such as buying a machine, transportation of machine, site preparation for installation of machine and expenditure incurred on its installation and trial runs. Thus, accounting identifies bunch of transactions relating to an economic event. If an economic event involves transactions between an outsider and an organization, these are known as external events. So here we have some of the example for such events. So where we will be having sale of Reebok shoes to the customer and rendering service to the customer by Videocom Limited, and purchase of material from suppliers, payment of monthly rent to the landlord. So these are the transactions which were external one. So then we have internal events. So here an internal event is an economic event that occurs entirely between the internal wings of an enterprise. For example, supply of raw material or components by the store department to the manufacturing department and payment of wages to the employees, etc. So what we have discussed here is economic event. So economic event is nothing but wherever we have transaction, there money takes place. So wherever there is money, so it is nothing but the economic event. So here if the event or the transaction is between the outsider and the organization, that transaction is called as external event. So if the transaction is within the organization, so like we have taken the example of supplying of raw material from the store to the manufacturing department or production department, such event is called as internal event. So now let us take the second point where we have identification, measurement, recording and communication. So let us take one by one and we will try to understand this. So first thing we have is identification. It means determining what transaction to record. So it is nothing but here whatever transactions we have in the business organization, we have to see that which transaction is to be recorded and which transaction we have to ignore. So as discussed earlier, we are going to record the transactions which are in terms of money, and to identify events which are to be recorded, it involves observing activities and selecting those events that are of considered financial character. So it means that those transactions which are dealing with the financial character, those transactions we are going to record in the books of account. For example, the value of human resources and changes in managerial policies or appointment of personnel are important, but none of these record in the books of accounts. So here when coming to the example, if we are hiring any employee or if we are hiring any personnel, for example, the value of human resources, changes in managerial policies or appointment of personnel are important, but none of these are recorded in books of account. However, when a company makes a sale or purchase, whether on cash or credit or pay salary, it is recorded in the books of accounts. So here identification point is very clear that first we have to identify the transaction or the activity in the business, whether it should be recorded in accounts or not. Now the next thing we have is measurement. It means quantification and it includes estimates of business transaction into financial terms by using monetary units, which is in rupee or in paisa as a measurement unit. If an event cannot be quantified in monetary terms, it is not considered for recording in financial accounts. So it is very clear that whatever transaction we have, it should be measured in the terms of money. If not, we cannot record those transactions in the financial accounts. Then we have recording. Once the economic events are identified and measured in financial terms, these are recorded in books of accounts in monetary terms and in a chronological order. Recording is done in a manner that the necessary financial information is summarized as per well established practice and is made available as and when required. So once it is identified and measured, all the transactions will be recorded in the books of accounts in monetary terms and in the chronological order, so that whenever there is a need of accounting information, this information will be provided for the users. Then we have communication. So when coming to the communication, the economic events are identified, measured and recorded in order that to pertinent information is generated and communicated in a certain form to management and other internal and external users. So as discussed earlier, internal users will be inside the organization and external users are those who are outside the organization. So when coming to internal organizations, we may have subordinates or we may have managers or board of directors, chief executive officers, etc. So where top level management will be there, the financial reports will be communicated with the management and the top level management. But when coming to the external users, we may have the investors, we may have the suppliers, we may have the government or the income tax departments, those who will be requiring the information of the accounts. Then we have organization. Organization refers to a business enterprise, whether for profit or not for profit motive. Depending upon the size of activities and levels of business operation, it can be sole proprietorship, a partnership firm, a cooperative society, or a company, or a local authority, or municipal corporation, or any other association of person. Now let us see interested users of information. So here accounting is a means by which necessary financial information about business enterprise is communicated and is also called a language of business. Many users need financial information in order to make important decisions. These users can be divided into broad two categories, where I said internal and external. So coming to internal users, we have chief executive, financial officer, vice president, business unit manager, plant manager, store manager, line supervisors, etc. So when coming to the external users, we have present and potential investors. So as I said, shareholders, then creditors, where we will be having bank and other financial institutions, or debentures or other lenders. And as I said, we have tax authorities, then regulatory agencies like Department of Company Affairs, Registrar of Companies, Securities Exchange Board of India, labor unions, trade associations, stock exchange and customers, etc. So when coming to the internal users and external users, we have the list of users who will be requiring the accounting information. So now let us see accounting as a source of information. As discussed earlier, accounting is a definite process of the interlinked activities that begins with the identification of transaction and ends with the preparation of financial statement. Every step in the process of accounting generates information. Generation of information is not an end in itself. It means a facilitate the dissemination of information among different users group. Such information enables the interested parties to take appropriate decision. Therefore, dissemination of information is an essential function of accounting. To be useful, the accounting information should ensure to provide information for making economic decisions and serve the user who rely on financial statement as their principal source of information, and provide information useful for predicting and evaluating the amount, timing and uncertainty of potential cash flow, and to provide information for judging management ability to utilize resources effectively in meeting goals, and to provide factual and interpretative information by disclosing underlying assumptions on matters subject to interpretation, evaluation, prediction or estimation, and to provide information on activities affecting the societies. Now let us see the role of an accountant in generating accounting information to observe, screen and recognize events and transactions, to measure the process and them, and thereby compile reports comprising accounting information that are communicated to the users. These are then interpreted, decoded and used by management and other user groups. And it must be ensured that the information provided is relevant, adequate and reliable for decision making. So whatever information we are going to provide, that information should be reliable and it has to be complete. Then the apparently divergent need of internal and external users of accounting information have resulted in the development of sub-discipline within the accounting discipline, namely financial accounting, cost accounting and management accounting. So when coming to the financial accounting assists in keeping systematic records of financial transaction, the preparation and presentation of financial reports in order to arrive at the measure of organizational success and financial soundness. It relates the past period and serves the stewardship function and in a monetary in nature. It is primarily concerned with the provision of financial information to all stakeholders. Now coming to the cost accounting assists in analyzing the expenditure of ascertaining the cost of various products manufactured or service provided by the firm and fixation of prices thereof. It also helps in controlling the cost and providing necessary costing information to management for decision making. When coming to the management accounting deals with the provision of necessary accounting information to people within the organization to enable them in decision making, planning and controlling business operation. So when coming to the management accounting draws the relevant information mainly from financial accounting and cost accounting, which helps the management in budgeting, accessing profitability, taking price decision. Management accounting draws the relevant information mainly from financial accounting and cost accounting, which helps the management in budgeting, accessing profitability, taking pricing decision, capital expenditure decision and so on. Besides, it generates other information which relates to the future and its relevance for decision making in the organization. Such information includes sales forecast, cash flows, purchase requirement, manpower need, environmental data about effects on air, water, land, natural resources, human health, social responsibilities, etc. As a result, the scope of accounting has become so vast that new areas like human resource accounting, social accounting, responsibility accounting have also gained prominence. Now, let us see the qualitative characteristics of accounting information. Qualitative characteristics are the attributes of accounting information which tend to enhance its understandability and usefulness. In order to access whether accounting information is decision useful, it must possess the characteristics of reliability, relevance, understandability and comparability. So when coming to the characteristics of accounting, we have the four most important characteristics of accounting, which is reliability, relevance, understandability and comparability. So when coming to the reliability, whatever accounting information we are going to prepare or the reports which we are going to prepare, it should be reliable. So here there should be less fraudulent activities in the accounts, or we should not. So when coming to the qualitative characteristics of accounting information, so the information should be reliable, relevance, understandable and the comparable. So here when coming to the reliability, whatever accounting reports we are going to prepare, it should be reliable. It means that the information should not depend upon the another information, or the report should not depend upon the another report. So whatever report we are going to prepare or whatever information we are going to provide, in itself it has to be provide the result. So here when the report is provided, the user should not feel that this report is incomplete and another report has to be added to this. So there should be a reliability on the accounting information. And coming to the relevance, it means that whatever information we have provided, it should be relevant to that particular report. So irrelevant information we should not fill in the report where it is irrelevant. Or then we have understandability. So accounting information, whatever report we are going to prepare, it has to be prepared in such a manner that each and every user should be in the position to understand that particular information. So here we cannot use such terms that the outsiders or the external users cannot understand such terms. So here that is one of the characteristic here, that whatever accounting information we are going to prepare, each and every person should be able to understand that particular accounting information. Then we have comparability. So it means that whatever accounting reports we are going to prepare, that report should be able to compare with the another report. For example, if we are reporting financial statement of this particular year, and that particular financial statement can be compared with the previous financial statements. So here to find out the profit, whether the business profit is increasing or decreasing, how we have to find out this? So we can analyze this by comparing this accounts with the previous year's financial statements. So that is what comparability. So here the accounting information whatever we are going to provide, they should have a characteristics that it can be compared with any financial statement. Liabilities. So liabilities are obligations or debts that an enterprise have to pay at some time in the future. They represent creditors' claims on the firm asset. Both small and big business find it necessary to borrow money at one time or the other, and to purchase goods on credit. For example, super bazaar. So when coming to the liabilities, it is nothing but the debt which is borrowed from the outside. So here the debt can be borrowed from the bank, or it can be borrowed for the financial institutions, or it can be borrowed from the suppliers. So here liability is nothing but it is a property of the outsiders which has to be paid today or tomorrow. So coming to the liability, we have long term liability and short term liability. So long term liabilities are those that are usually payable after a period of 1 year. For example, a term loan from a financial institution or debenture bonds issued by a company. So coming to the short term liabilities are the obligations that are payable within a period of 1 year. For example, creditors, bills payable, bank overdraft. So here we can say that liability is nothing but an amount which is borrowed from the outsider. It might be the bank, it might be the supplier, or it might be the financial institution or some borrowers. So that is the amount which we have to pay today or tomorrow. If that particular amount is repayable within 1 year, that particular amount will be called as short term liability. If the same amount we are going to pay after a period of 1 year, that such amount will be called as long term liability. So let us discuss the following characteristics. So first characteristics we have here, reliability. So reliability means the users must be able to depend on the information. A reliable information should be free from errors and bias, and faithfully represents what it is meant to represent. What it means here, when coming to the accounting information, it should be reliable. When it will be reliable? When the accounting information is free from errors and bias, and when it is faithfully presented. When the accounting information has an errors or it is biased according to the management, it is very difficult to believe or to trust whatever accounting information is provided to the users. So that the first characteristics itself is reliability. Whatever accounting information or whatever accounts we are going to prepare, it should be free from errors and it should be unbiased. The next characteristics we have relevance. To be relevant, information must be available in time, must help in prediction and feedback, and must influence the decisions of users by helping them from prediction about the outcomes of past, present or future events. So what happens here? When coming to the relevance, the accounting information whatever we are going to provide, it should be relevance in the sense whatever accounting information we are going to provide for the users will be comparing that particular outcome from past, for present and for the future purpose. So accounting information should be relevance here. It can be comparable with the future, past, or it can be for the present conditions, or confirming or correcting their past evaluations. So now once accounting information is prepared, it is not like it cannot be corrected. Okay, sometimes what happens here, the past accounting information whatever we have, we may have some errors in that particular errors can be corrected again. Then third characteristics we have understandability. Understandability means decision makers must interpret accounting information in the same sense as it is prepared and conveyed to them. A message is said to be effectively communicated when it is interpreted by the receiver of the message in the same sense in which the sender has sent. Account should present the comparable information in the most intelligible manner without sacrificing relevance and reliability. So when coming to the understandability here, what it means? It means here the person who is preparing the accounts and that particular accounts is forwarded for the users or for the management to take the decisions. So what the point here, whatever accounting information is prepared by the accountant, that particular account should be understandable for the each user. It means it should be prepared in such a manner that each and every person should be understandable about that particular information. And the last characteristics we have here, comparability. So it is not sufficient that the financial information is relevant and reliable at a particular time, in a particular circumstances, or for a particular reporting entity. But it is equally important that the users of the general purpose financial reports are able to compare various aspects of an entity over different time period and with other entities. To be comparable, accounting reports must belong to a common period and common unit of measurement and format of reporting. So when coming to the comparability here, whatever accounts we are going to prepare, that particular accounts is going to be compared with different accounting information. For example, if a particular organization is earning profits, so what happens here, the organization will be aiming that what is the present position of the business and how it can be improved. So that what they are going to do here, they are going to compare the present accounting information with the past accounting information. So accounting information must be prepared in such a way that it can be compared from one year to the another year. By comparing with the past year, we can decide that what is the position of the business, how it can be improved. Okay, for example, in the year 2016, if the business is earning 1 lakh rupees of profit, in the year 2017 we want to improvise that. So that what we are going to do here, we are going to compare the accounts, we will see that where we are lagging behind and how we can overcome with that particular thing. And the next thing we have here, objectives of accounting. As an information system, the basic objective of accounting is to provide useful information to the interested group of users, both external and internal. As discussed earlier, accounting information or accounts what we are going to prepare, it is not only meant for the accounting purpose. Okay, so previously I said that accounting is a process of recording, classifying and summarizing business transactions. So here, as said before, accounting information is not only meant for the accounting purpose, it is also meant for communicating the same information with the users. Again, it was discussed earlier that whatever accounting information we are going to prepare, it is communicated with the interested users, where when coming to the interested users, we have internal users and external users. So the basic objective of the business here is whatever information we are going to prepare, that should be accounted and the same have to be communicated with the interested users. Apart from this, let's see what is the objectives of the business. The first objective we have here, maintenance of records of business transactions. Accounting is used for maintenance of systematic record of all financial transactions in books of accounts. So the very basic objective here is whatever transactions we have in the business, it might be purchases or it might be sales, it might be purchase of raw material or it might be sale of final goods. Every transaction should be recorded in a books of accounts. And the second objective we have, calculation of profit and loss. The owners of business are keen to have an idea about the net results of their business operations periodically, that is, whether the business has earned profit or incurred losses. Thus, another objective of accounting is to ascertain the profit earned or the loss sustained by a business during an accounting period. So let me explain this point. When coming to the business organization, the business organization will be curious to know that whether their business is earning profit or loss. Again, when coming to the objective of accounting here, the second objective itself is calculation of profit and loss. So now, when coming to the objective, the accounting itself want to know that whether the business is earning profit or loss. With the help of accounting, the business organization can come to know that whether that particular organization is earning profit or loss. If they are earning profit, no issues. When they are earning loss, the business have to set the strategies here to overcome the loss and to earn the profit. And let's see the next objective we have, depiction of financial position. Accounting also aims at ascertaining the financial position of the business concern in a form of its assets and liabilities at the end of every accounting period. A proper record of resources owned by business organization, which means asset, and claims against such resources called liabilities, facilitate the preparation of a statement known as balance sheet position statement. So what is here? Depiction of financial position. So when coming to every organization, they used to have liabilities and they used to have asset. So now when coming to the liability, liability is what? Like responsibility or the debts which we have to clear today or tomorrow. For example, if we are purchasing any raw material on credit, that particular raw material what we are purchasing on credit, for that we have to make the payment, not instantly but in future we have to pay them. So that will become a liability here. Same like we are going to get the capital from the shareholders. So whatever capital we are going to get from the shareholders, at the end we have to repay that particular capital. So again it will become a liability. Same like if we have any outstanding expenses which are to be paid, that expenses will become a liability. Again, opposite to that we will be having assets. Assets in the sense it is a property of business until the business is liquidated. Okay, so now whatever capital we have raised from the shareholders, that capital we are going to invest in the business. We will purchase the building, we will purchase machineries, we will purchase furniture. So till the organization is going to carry its business, this particular assets will be in the business. At the end, if the business is liquidated, we are going to sell that particular assets and we are going to clear the debts. How we are going to come what we have in the organization, what assets we have and what liabilities we are supposed to pay, that we are going to come to know with the help of only accounting information. Since this is the third objective of business, knowing the financial position of the business. And the next thing we have, the next objective we have here, providing accounting information to its user. So accounting information generated by accounting processes is communicated in the form of reports, statements, graphs and charts to the users who need it in different decision situations. So what happens here, whatever accounting information we are going to prepare, it will be prepared in the different forms, okay, as required by the interested users. Some accounting information will be in the form of charts, some accounting information will be in the form of graphs. So whatever information we are going to prepare, that will be communicated with the interested user. So that is the last objective of the business. So now let us see what are the basic terms used in accounting. Okay, so when coming to the basic terms here, altogether we have approximate 20 terms which is used in the accounting process, and each and every term is very important. So let us see one by one. The first term we have entity. Entity means a thing that has a definite individual existence. Business entity means a specially identifiable business enterprise like Super Bazaar, Hire Jewelries, ITC Limited, etc. An accounting system is always devised for a specific business entity, also called accounting entity. So what happens here, when coming to the terms, first we have entity. Okay, to have an accounting process in a particular business, we should have an entity. Okay, the term itself denotes here we should have an entity, in the sense in a business we are going to maintain the accounting process. Okay, so without business, without any individual business or a particular business entity, we cannot maintain the books of accounts. So that it is very compulsory that we should have an individual business or we should have an individual entity. Okay, like example I have given, Super Bazaar. Okay, so when coming to the Super Bazaar, we will be having different outlets inside the Super Bazaar, so that we can maintain the accounting process here to record that what is that business of that particular day, of a particular month, or of a particular year. And the second term used, we have here transaction. An event involving some value between two or more entities. It can be a purchase of goods, receipt of money, payment to a creditor, incurring expenses, etc. It can be a cash transaction or a credit transaction. So now when coming to the second term here, to maintain an accounting book or to maintain an accounting process, we should have a transaction in the business. Now we have a business entity, but we don't have any transactions. Now there is no question of maintaining accounts. So that as I said, we should have an entity, we should have an business. In that business we should have transactions. It might be purchase of raw material or it might be sale of final goods. Now the purchase of raw material or sale of final goods can be on cash basis or it can be on credit basis. Whatever it is, there should be a transaction that can be recorded in the books of accounts. And the third term we have here, asset. Assets are economic resources of an enterprise that can be usually expressed in monetary terms. Asset can be broadly classified into two types. One is fixed asset, another is current asset. So let us see what is fixed assets. Fixed assets are assets held on a long-term basis, such as land, building, machinery, plant, furniture and fixtures. These assets are used for the normal operation of the business. So now when coming to the asset, it is going to be divided into two categories. One is fixed asset and another is current asset. Fixed asset in the sense which is going to be in the organization for a long period of time, and another side it is used for the basic operation of the business. In the sense, for example, if it is a manufacturing industry, when coming to the manufacturing industry, we should have a particular organization, we should have a building. Once we have a building, we should have a machinery. Why we want machinery here? To manufacture the products. Again, we will be having a particular plant. Okay, so in the sense, to manufacture one product, we will be requiring the plant. Okay, in the sense, first machinery will be converting the raw material into the semi-finished goods. Second machinery will be converting that semi-finished goods into the finished goods. Once it is finished, it is going to be packed. Once it is packed, it will be labeled. Once it is labeled, it will be transported. Like we will be having plant in the organization, whatever assets we are going to use inside the organization for a normal operation, that particular assets are called as fixed asset. The next term used in accounting is capital. Amount invested by the owner in the firm is known as capital. It may be brought in the form of cash or asset by the owner for the business entity. Capital is an obligation and a claim on the asset of business. It is therefore shown as capital on the liabilities side of the balance sheet. So when coming to the capital, it is a owner's fund which is brought into the business. Now when coming to the capital, for example, when coming to a partnership firm, okay, so assume that we have 3 partners. Okay, we have Anil, Bharat and Chandan. These 3 partners are going to start a business. They are going to start a partnership firm. Each partner, okay, so again each partner is going to bring 50,000 to the business. So altogether the capital will be 1,50,000. But what capital they are investing in the business, it will be in the liabilities side, so that at the end of the business that should be repaid to the partners. So now capital is nothing but a fund which is brought into the business by the owners. The next term we have here, sales. Sales are total revenues from goods or services sold or provided to customers. Sales may be cash sales or credit sales. So now in other terms we can say that sales are the revenue to the business, or you can say income is generated when sales arises. Now when coming to the organization, we are going to purchase the raw material, we are going to convert that raw material into the finished goods, we are going to provide a packing for that, we are going to provide label, etc., etc. We used to spend amount on that particular product. The income will not generated until and unless the product is sold. Okay, so for a business organization, once we are manufacturing a particular product, until and unless it is sold, we are not going to get the income. So sales is nothing but a revenue or income which is generated in the business. Again, that particular sale can be on the cash basis or it can be on the credit basis. Cash basis in the sense instantly we are going to get the cash, credit basis in the sense the payments will be made on the future date. Now again coming to the next term, we have revenues. These are the amounts of the business earned by selling its products or providing services to customers, called sales revenue. Other items of revenue common to many businesses are commission, interest, dividends, royalties, rent received, etc. Revenue is also called income. So what happens here, when coming to the business organization, suppose they are receiving a rent of some of the departments, or they are providing some activities or some services to the outsiders, out of that they are going to get the income. That particular income is called as revenues here. Now let us see the next term used in accounting is expenses. Cost incurred by a business in the process of earning revenue are known as expenses. Generally, expenses are measured by the cost of asset consumed or services used an accounting period. The usual item of expenses are depreciation, rent, wages, salary, interest, cost of heater, light and water, telephone, etc. So what happens here, when coming to the cost, it is nothing but an expenditure incurred in the process of manufacturing any commodity. So now whatever expenses we have in the business, it might be electricity bill or it might be maintenance of the assets, like we are going to charge the depreciation for the asset. So these things are called as the expenses. And the next we have expenditure. Spending money or incurring a liability for some benefit, service or property received is called expenditure. Payment of rent, salary, purchase of goods, purchase of machinery, purchase of furniture, etc. are example of expenditure. If the benefit of expenditure is exhausted within a year, it is treated as an expense, also called revenue expenditure. On the other hand, the benefit of an expenditure lasts for more than a year, it is treated as an asset, also called capital expenditure, such as purchase of machinery, furniture, etc. So now when coming to the expenditure, that is the amount which we are going to spend in the organization. What amount we are going to spend here? For example, we are going to install the lights and fans in the organization. So now whatever lightings and fans we are going to install, these fans and lightings are not going to provide the benefit within a period of 1 year. They are going to provide us the benefit for a long period of time. So whatever amount we are going to spend on such asset is called capital expenditure. Again, vice versa to that, if we are paying a rent of the organization, that we are going to pay the rent for the monthly basis. Okay, so entire month we have used that particular organization, so that we are going to pay the rent. Okay, so now any expenditure out of that, the benefit is exhausted within a period of 1 year, that particular expenditure is called revenue expenditure. Now let us see the next term. We have profit. The excess of revenue for a period over its related expenses during an accounting year profit. Profit increases the investment of the owners. So here profit is nothing but whatever expenditures we have in the business. Okay, so whatever expenses and whatever amount we are going to spend in the organization for manufacturing of particular product. When that particular product is sold, we will be getting the amount. Okay, so in that amount we are going to deduct this particular expenditures. The leftover amount is called as profit. Okay, let me repeat once again. Profit is nothing but whatever expenses we have and what is the amount we are getting out of the sales. In sales we are going to deduct the expenditures, then we are going to get the profit. Now let us see the next term what we have in the business. We have gain. Gain in the sense a profit that arises from events or transactions which are incidental to business, such as sale of fixed asset, winning of a court case, appreciation in the value of an asset. So now, as I said before, profit is nothing but what is the value we are getting out of the sales minus what are expenditures we have. But when coming to the gain, it is incidental. Okay, so we don't have any idea that we are going to get the gain. But when coming to the gain, what happens here? For example, whatever assets we have in the business, for example, we have land and building. When we purchase this particular land, the value of this land is 60,000, but over a period of year, that particular value of that land has become 80,000. So what is the appreciation here? 60,000, it has become 80,000. So total 20,000 was the appreciation. It is a gain to the organization. Okay, again in the simple terms, the gain which we are not getting from the business operation, but it is an incidental income to the business. Now let us see the next term what we have, loss. The excess of expenses of a period over its related revenue is termed as loss. It decreases in owner's equity. It also refers to money or money's worth lost without receiving any benefit in return. Example, cash or goods lost by theft or a fire accident, etc. It also includes loss on sale of fixed asset. Okay, so now coming to the previous thing, I said that the building value was increased to 20,000. Similarly, when we are going to purchase the asset, like we are going to purchase the machinery, for example, we have purchased a machinery for 1 lakh rupees. Okay, so over a period of time, the value of that particular machinery will be reducing, it will be decreasing because of the regular use of that particular machinery. So what happens here, what machinery we have purchased for rupees 1 lakh, that particular machinery will lose its value. Okay, for example, 1 lakh rupees machinery which was purchased in the year 2014, in the year 2015 it will be evaluated for 80,000. Okay, so now 1 lakh minus 80,000, 20,000 what we are getting, that is a loss. Now let us see the next term. We have discount. Discount is the deduction in the price of the goods sold. It is offered in two ways. Offering deduction of agreed percentage of list price at the time of selling goods is one way of giving discount. Such discount is called trade discount. And another thing we have, after selling the goods on credit basis, the debtors may be given certain deduction in amount due in case if the party the amount within the stipulated period or earlier. So what happens here, when coming to the discount, it is given by the organization to the debtors, or it is given by the organization to the person at the time of selling the particular commodity. So here, suppose we are supposed to receive amount from the debtors. If he is repaying that particular amount within a period of time, we are going to provide him a discount so that we can motivate him to return all the amount which he is supposed to repay. Same here, when coming to the particular products are sold. Okay, so when the particular sales happens, once we give the trade discount, again what happens here, it will motivate the customer to purchase more and more products from the particular organization so that he may get the trade discount. The next term we have here, voucher. The documentary evidence in support of a transaction is known as a voucher. For example, if we buy goods for cash, we get memo. If we buy goods on credit, we get an invoice. When we make a payment, we get a receipt and so on. So here voucher is nothing but an evidence for the particular transaction. Okay, so whenever we are going to make the purchases or whenever the organization is going to make the sales, they have to draw a bill. That particular bill is called as voucher. Now let us move for the next term. We have goods. It refers to the product in which the business unit is dealing, that is, in terms of which it is buying and selling or producing and selling. The items that are purchased for use in the business are not called goods. Okay, for example, for a furniture dealer, purchase of chairs and tables is termed as goods, while for other it is furniture and it is treated as an asset. Again similarly, for a stationery merchant, stationery is goods, whereas for other it is an item of expense, not purchases. So when coming to the goods here, in a particular organization, if that organization is dealing in purchase and sale of that particular item, as I gave the example, for a furniture dealer, purchase of chairs and tables are goods, but same for the other organization, those who are not dealing in the furniture, that will become an asset of the organization. Similarly, one more example I said, stationery. For stationery dealer, stationery items like scale, pen, pencil, papers, etc. will become goods because he is purchasing that, again he is selling that. Again, for other organizations, whatever pen, pencil, stationeries like papers they are using, that will become an expense, not a purchase or not a goods. Now let us move for the next term. We have drawings. Withdrawal of money or goods by the owner from the business for personal use is known as drawings. Drawings reduces the investment of the owners. Now, when coming to a partnership firm, we will be having 2 or more partners. What capital they are going to bring into the business, that is termed as capital. Okay, I mean what cash they are bringing in the business, that is called as capital. If that capital is going to be in the organization for a long period of time, it will generate more income. So here, once they are investing the capital, after that if they are withdrawing any amount for their personal use, that amount is called as drawings. Ultimately what happens here, if a person A is investing 10,000 rupees in a business, after 3 months if he is withdrawing 2,000 rupees, what happens here, his investment was 10,000, drawings were 2,000, it reduces the investment from 10,000, it will come to the 8,000. The earning capacity of that particular person will be reduced. Now, let us see the next term what we have, purchases. So, purchases are total amount of goods procured by a business on credit and on cash for use or sale. In a trading concern, purchases are made of merchandise for resale with or without processing. In manufacturing concern, raw materials are purchased, processed further into finished goods and then sold. Purchases may be cash purchases or credit purchases. So here, purchases means in an organization they are going to purchase the raw material for the sake of manufacturing the final goods. Okay, so whatever raw material we are going to get inside the organization, that is what purchases. Okay, so now that particular purchases can be cash purchase or credit purchase. Cash purchase in the sense instantly we are going to make the payment for the supplier. Again, credit purchase in the sense we are going to make the payment on the future date to the supplier. So that is what purchases. Here the next term used in the business is stock. Stock is also called stock in hand. In a trading concern, the stock on hand is the amount of goods which are lying unsold as at the end of an accounting period is called closing stock. In a manufacturing company, closing stock comprises raw materials, semi-finished goods and finished goods on hand on the closing date. Similarly, opening stock is the amount of stock at the beginning of the accounting period. So now, when coming to the stock, here stock is also called as stock in trade or it is also called as inventory. Okay, so now when coming to the stock, it is nothing but a unsold part of the sales. Whatever commodities we are going to manufacture, it is for the purpose of sale. Any unsold commodity will be lying in the organization. That particular commodity is called as stock. Okay, it might be raw material, it might be semi-finished goods or it might be finished goods. Okay, which is lying in the organization is called stock. Again, the same stock can be used for the next year. At the end of this year, that stock will be considered as closing stock. For example, the value of closing stock is 40,000. Same 40,000 worth of stock we can utilize in the next year. Again, that 40,000 what closing stock we have, that will become opening stock for the next year 40,000. Now let us see the next term we have debtors. Debtors are persons or other entities who owe to an enterprise an amount for buying goods and services on credit. The total amount standing against such persons or entities on the closing date is shown in the balance sheet as sundry debtors on the asset side. For example, if your organization is selling commodities on credit basis, Okay, when we sell the commodities on credit, we are supposed to receive amount for that particular sales in a future date. Okay, so what amount we are supposed to receive from that person is called as debtors. So these debtors will be shown in the asset side because the amount is supposed to be received, which we can receive today or tomorrow. Let's see the last term we have here, creditors. Creditors are persons or other entities who have to be paid by an enterprise an amount for providing the enterprise goods and services on credit. The total amount standing to the favor of such person or entities on the closing date is shown in the balance sheet as sundry creditors on the liabilities side. So now we have two concepts here. Okay, one which was earlierly discussed, debtors, and the second is creditors. Debtors in the sense the organization is supposed to receive the money. Similarly, when coming to the creditors, the organization have to pay to the creditors. What amount we are supposed to receive will become asset. What amount we are supposed to pay will become a liability. Okay, for example, we are purchasing raw material on credit. Whatever raw materials we are purchasing on credit, for that we have to make a payment in the future date. Okay, for whom we have to pay, that person is called as creditor.